Okay, ready to roll. This time I get to ask the questions, and there aren't going to be many. But first, briefly introduce David Shapiro, reading from your right to left, David Shapiro from FiRe, Scott Darling from Intel Capital, and Dan Rosen from Frazier Ventures. I really have two questions for each of you, and I thought it might be useful to start in reverse order. So maybe starting with David, what are you doing your best to learn about today in order to be an intelligent investor, let's say, 3 years from now?
Okay, so certain areas that I think we find interesting, some of which have been mentioned already, through the sessions, but I think where we're spending some time, and I'll answer this, FiRe as a firm has lots of areas of interest, lots of folks, and so these are interested a little bit more where I see some promise, but I think there's some segments around healthcare IT, I think, is there's some trends that we're seeing that are coming together. It's been a typically generally bad area to be investing in for the past couple decades, but there's some good trends that are coming together. In particular, in the future, so there's some current and there's some in the future. If I look out a couple years, maybe it's around the consumer. Unlocking the power of the consumer and bringing that to bear to provide more transparency or as a means to help make healthcare be more productive, basically. This might be personal healthcare records as an example, or other forms like that. I think also nanotechnology is something not to be dismissed. Certainly the panel today covered it in depth, but the confluence of nanotechnology and biotech, you could see some of the promise. It makes just perfect sense to have drugs be able to be delivered right to the point of the cancer. Those kinds of things, personalized medicine, are trends that we're trying to position ourselves and get smart on. And I think alternative energy, clean tech is another. It's a little bit of the area du jour in venture, but I think FiRe has spent a lot of time focused on that in the past. We have investments. We have a whole team of oil and gas folks in Aberdeen, and so they've been looking at things like ocean power and solar and wind for a while, and I think now it just makes more economic sense. So we'll see that trend play out continually over the next couple of years as well.
Okay, Scott, you've at Intel, there's been a very broad range of planting a lot of seeds that will generate microprocessor cycles in the future. So looking out again, not what you're trying to invest in the next 12 months, but looking out 3 years from now, where do you think you need to be getting educated?
Sure. To echo David's comments, Intel Capital is a pretty large organization. We've got about 100 investment professionals spread around the planet, probably 60% of them outside of the United States. I manage the area that does what we call our enterprise investing, so I'll address your question from that perspective. Sure. I can discuss other areas too, but the things that are longer term, maybe that's a polite way of asking what kind of things have you struggled with that have not yet, we've been looking at them for years and they've looked too early or they've looked like science projects. So this is not necessarily the list of great promise. These could continue to be the list of many sunken dollars. But
the way healthcare IT has been for 25 years.
Right.
Yeah.
Right. So one of the trends that I think is interesting is it's very clear that microprocessors, there was this really interesting experience I had inside of Intel probably about 3 years ago. The big jockeys were the circuit designers. And I remember sitting in a product planning meeting at one time, and the lowly thermal guys were dictating circuit architecture. They were saying, well, you can't put those circuits there because they're too close to some other circuits. The registers, which are always running, are very hot. And that was a watershed moment. And we're going to be seeing more of that coming forward as we enter what I call the era of terascale. And what I mean by that is many core machines, like 20, 30, 40-way cores. And the implications of this in terms of architecture, I/O, fabrics inside the data center, all these sort of things are really quite profound. And I'll address, I think we're going to talk about what things look promising in the next 12 months later, but we'll talk about some of the specific things we're doing there. But I think the era of terascale is an interesting one. The other thing that gets interesting is I think there's this trend in the enterprise where technologies that are finding promise in the consumer sector are migrating into the enterprise. So the ones that we're all familiar with that are classics are things like, instant messaging and collaboration. Those things, IT, Steve Jobs has an unfriendly term to describe the role of IT managers as one of the great orifices of the world. And they really resisted those kind of collaboration technologies, even though people working in dispersed teams really need them. So I think there's a bunch of interesting technology. One of them is what I would call, that we've wrestled with, is this idea of reconfigurable logic. And I think where it comes from is if you look in the consumer space, people have been building SoC, system on chip devices, for like set-top boxes, and they have a little processor, and they have a mod and demodulator and a scaler and all these kind of things, and they're fixed function blocks. Well, if you look at the enterprise, we have similar issues, right? You have XML accelerators, Java accelerators, SSL accelerators, and these are all going to have to get wrapped around a general computing device. So I think and of course, it'll be much more simplified if you can use reconfigurable logic, and you're not having to physically build these blocks into a device. So again, these are things that are perhaps 3 to 5 years out. And then the last one I'll touch on is when we get to what I call the data center 2.0 here in a minute, is as you get to these commoditized blocks of compute or I/O or storage, you're going to have lots of them, and you'll scale them well. But then you get into this problem of how do you manage them, and how do they heal themselves when they go down, and these kind of things. But very complex problems. These may be 3-5 years away kind of investments.
We hope they're a little closer since we're backing Bill Coleman at Kasai to do it again.
Yeah. More in the management space.
Absolutely. Well, and automating provisioning and tuning the computing and storage infrastructure to the application load.
In fact, I would agree with you. I would put that in the 12 to 24 month kind of category. So,
Hope you're right. Dan, you're operating at a somewhat different scale from Intel and 3i, so I think your perspective will be very relevant to a lot of the folks here.
Well, also about 3 weeks ago, it wasn't updated on the screen, but I left Frazier. And I now am exactly the opposite of Scott. I'm a sole practitioner, investor, and help entrepreneurs. So absolutely at the other extreme of the scale.
Well, I noticed that halo made you an angel, the sort of the way the light, the nimbus behind you.
More than you know. But I've always been focused on breakthroughs more than on taking the things that currently exist and seeing how to make them better, because I feel like that's what venture capitalists should do, or at least some of us should. But secondly, that somebody's got to do it, because if the new breakthroughs don't happen, then a lot of the stuff we're talking about from a vision point of view don't. At the moment, I'm personally focused on learning a lot more about where wireless goes. Because as we've talked in this conference, and as Mark often talks about in SNS newsletter, we know that there's more wireless endpoints in the network than there are wired now. We also know that the sale of all sorts of devices that people are going to use wirelessly, including probably about half the people in this room with their laptops hooked up wirelessly, are happening. And we know that the evolution of those networks is happening at a more rapid pace now than the wired networks are happening. So as I look at the wireless infrastructure, I see several things. One is that there's going to be a proliferation of networks and a convergence of those networks at the endpoints. And managing that and enabling that is going to be very difficult, and there are going to be a lot of pieces of technology created to do that.
So just to get a little specific there, are you talking about convergence from 3G cellular to Wi-Fi, maybe WiMAX?
And WiMAX,
and
yes.
Flipping back?
And so clearly, if you have a primarily data device like a laptop, you're going to want the ability, as Michael Dell said yesterday, to work across those. The technology to do that is in its infancy. And as more networks happen in more places, you're going to want to be able to do that seamlessly, and it's going to have to be easy for consumers. I think there's a lot of opportunities for startups in that area.
The
Joe?
second one is the applications that then run on those networks once you have them. And I've been a student of that for quite some time at Microsoft before I became a venture capitalist and while I was a venture capitalist. And I see a lot of opportunities for very small companies to create a lot of infrastructure, which sort of gets me to my last point, which is not what kind of technology I'm looking at, but the kind of company. I think that there's still an opportunity for big venture funds to invest $100 million in a startup and do something unique. Some of the network infrastructure companies require that. But I think the kinds of companies I'm describing are very capital efficient. Create their prototype product on very little money, total life cycle under 20 million, maybe under $10 million to get to cash flow positive. And so I look for companies that are very capital efficient in doing what they do, as well as companies in those technology areas.
That's a very interesting last point. Looking at the venture economics data, which I do on a quarterly basis, one of the really striking differences between the pre-bubble world and the post-bubble world has been the threshold, whether measured in terms of dollars invested, number of years, in order to get to be IPO-able. And if you go back to the world of the first half of the 90s, wasn't the greatest stock market environment ever, but you're talking about companies with typically on the order of 10 to 15 million, and I'm not just software, but 10 to 15 million and 3 to 4 years to IPO. Now you're looking at 50 to 75 million and 6 to 7 years, and let me tell you, you don't have to have Larry Smarr's math degrees to work out that the ROI on the latter is a hell of a lot lower, particularly when the valuation metrics at IPO time are no better than they were back in '94.
In fact, probably worse.
So does that mean that you're looking at building to sell rather than to IPO? Startups, and this, I'm going to go back to all three of you on this question. Is it more the outsourced R&D model, and before you actually have to have that your path to liquidity is through selling what you've got rather than the long-term play as a public standalone company?
Well, no. I think that the difference is going to be that a lot more creativity is going to be needed to get companies liquid than it has been in the past. Scott and I are involved in a fuel cell company. Well, Scott no longer is, I still am, because he'd correct me if I don't correct it for myself, called NIA Power in Bothell, Washington. And NIA Power is one of those companies that needed to do a concept IPO. It's still a ways from product. It still needs more capital. And what we decided to do to raise capital efficiently for it was do a reverse merger. And so far, it's been quite successful in that process. Although there was a lot of skepticism that it would be when we went down it. Another company I'm working with, which I described to you, we're taking out as a hedge fund because the other paths to liquidity just didn't seem to be there for some very unique and breakthrough technology. And so I think we just have to learn to be a lot more creative in taking some of these companies through to their end.
Scott, what's your experience now with the very broad-based portfolio?
Yeah, two comments on that. The first one is I think you actually do have to invest with a view to exit through M&A, and as Dan says, you don't want to do all your investments that way, but you clearly have to be thinking about that. And when you go and meet with teams, you ask them things, you make sure that the fundamental architecture of the products makes sense for the potential acquirers and that kind of things. But I'll make a little bit of a bolder statement if I can, which is that if you look at the numbers today in venture, the model is broken. Three-quarters of the companies are exiting via M&A. The average multiple is a 2x on capital in. Yep. You run the numbers, 50% of the companies fail. A
2x multiple, that comes out to not a very good outcome.
And
not after management fees.
I'll take the risk-free rate.
Yeah, exactly. 5% looks pretty interesting from that point of view.
Fees.
So, something's going to give. Either the IPO markets are going to reopen, or the amount of dollars put to work is going to have to change, or the model's going to have to change something. We're in this kind of interesting period where which vector we're going to go down in terms of fixing the model, I don't know.
David, you're the one I should ask, given 3i's roots as a British, in fact, really in a sense, the foundation British venture business. Around Silicon Valley, you go from one seminar on the AIM market to another. The guys I know, the old timers in New York who go back in the IPO market for tech companies like Tommy Underberg is commuting to London and getting qualified to do AIM offerings. Are you guys taking your portfolio public there?
We're certainly seeing more activity around that. I think the UK guys, well, I would echo what these guys say, and I'll come back to them, the comments, the prior question in a moment. I think AIM it gets to what Dan was saying, that you have to get a little more creative about how you think about exits, and AIM has, I think, increasingly cropped up as a potential viable consideration. I think the way I look at it more as a liquidity event than an exit event. I'm sorry, financing event rather than a liquidity event.
Right.
So you might be able to get some out, but it's more around maybe you want to scale up and get $20 million to go acquire or do a roll-up. Those opportunities, I think, is where AIM can fulfill. I don't see it as a straight liquidity event. I think in the UK, folks were a little skeptical about AIM, and I think as time has passed, it's proven to be, we're all scratching our heads saying, hey, that's possible. We all have companies that are good, viable companies, maybe doing 15, 20, 30 million in revenue, clearly not at the IPO level for the NASDAQ as far as what you have to do to get out on an IPO basis, but maybe break even. Well, what do you do? AIM may be a viable opportunity for some of those companies, especially as they operate globally, as they think about a global market. If they sell globally, it's a little bit more appealing to the UK investors.
I'm afraid I myself share some of Scott's concern about the venture model as we live with it, because it has historically been so dependent on at least getting some proportion of your portfolio into the home run area, which comes from real liquidity in a real public market.
Right.
But having said that, you guys are all still in the game with your different institutional and non-institutional bases. So let's, in the last 10 minutes or so, bring it back to what, as my old partner, my old firm used to say, began every conversation this way: what do you like right now? Where are you spending your cycles? And maybe we'll start with David again and come back this way.
Sure. I think I'll start with one area that we've seen a lot of activity on and are still seeing it and think this is a trend that will continue is digital media, new media related things. So there's been obviously a lot of investment, a lot of press and buzz around user-generated content and video coming online. Let me park those for a moment. I'll give you a little bit more of a flavor. Some streams, these aren't direct investment streams, but these are possibilities. I think we're going to be faced with, there's navigation and the user interface hasn't been solved in the digital home. If you think of all the content that we have and are going to get sent to us, pushed to us, it's our photos online, our video, video on demand, TV, DVR, content from the internet. There's still my Comcast remote and user interface just aren't going to solve it. So there's some opportunity for some companies that are bright that maybe can help solve that navigation paradigm. Online advertising, I think there's still a disconnect between the dollars spent online and the amount of time that's disproportionately going that way. So 16 to 30 in particular as a real sweet spot demographic. I think now the stat is they're spending about equal amounts of time online as well as TV, but the dollars spent against that are far more in the TV and radio domains than in the online advertising. That said, I think there's ways to do it more smartly, so maybe more targeted ads, more relevant contextual, maybe even poll-based advertising. So some new advertising paradigms that relate to this online advertising trend. Thirdly, local is another one I think that hasn't been cracked. Google, Yahoo, Microsoft are squarely going to try and solve this. So, but maybe there's a way to play with them, and by that I mean making things contextual. GPS chipsets, we heard yesterday from Paul, they're going to be in every phone. They already are just about being shipped with every phone. But making that chipset, that data coming from that chipset, turning it into information for us as users. So things like, rather than just where am I, where can I find where's the nearest 3-star Italian restaurant in Coronado so I can grab a dinner that may even have a table reservation available. making it more like a concierge, so those kinds of applications that ride on some of the processing and increased elements around what's going into cell phones these days. And then I will mention also healthcare IT. I think there's some areas that make sense today. In addition, in the future, these trends are still in existence around e-prescribing, electronic medical records, things like that, maybe there's some opportunity.
Scott, the magic word chipsets was used there, which I could see you getting ready to address.
Yeah, chipsets, it makes me choke up. It's a very emotional subject for us. Actually, chipsets is an emotional subject for a reason, which I won't share with you or bore you with. Again, so touching from an enterprise point of view, because we invest in everything, we invested in Larry's company, Nanosys, to media companies across a wide range. But in the enterprise things, one of the things I'm just wrapping up is I had my team spend about 1.5 years, 2 years bottom fishing in the optical space. Because to your point earlier this morning, I do believe that there are these mood swings in the investor space. We went through nuclear winter.
Yesterday, we had the chance to see how Larry's guys have equipped an entire photonics lab at 3 cents on the dollar.
Sure, absolutely. And so we had a nice exit with a company called Pasave recently, and I just did an investment in a company called Stratolite, which basically all it is everybody hears all that there's so much bandwidth out there. The reality is the lit bandwidth is actually congested at this point. And so the operators whose revenues do not scale with the number of bits they ship directly. Right. So this company, Stratolite, basically you pull out a 10 gig line card, in essence, plug in a 40, it's all compatible, and they've got revenue, the product's installed at OEMs, and great company, and nobody wanted to invest in them. So examples of things like that. So that's one thing. The other thing that came up at the conference, I believe security investments are going to continue to be viable for a long time, because security investments are pure technology plays. They're best of breeds. And this is where, to your point earlier, you need to look at these in terms of who are the one of the 4 or 5 acquirers, because the possibility of building a standalone security company is pretty remote. But it's a cottage industry where you can find some really brilliant technical people who are working on a specific part of it, and it'll get fed into some kind of environment. Then the last,
it's also one where a startup can sell stuff to a big company if it works.
If it works,
because the need is so extreme. It's not an economic need. It sort of transcends the usual commercial calculus.
So here's one example in the security space. How many people in the audience have VoIP systems at work? I mean, not using Skype, but at work, right? There's basically no security systems on VoIP today. So if somebody wanted to be, really obnoxious, you could walk into work tomorrow and every phone in the office would be ringing nonstop for 5 hours, and they'd have to basically unplug the telecommunication system. The last one, which I think is a little bit more abstract, but I think is very compelling. It's really what I call it the next generation data center. Some people demean it and call it, data center 2.0, which, sounds like something we don't want to be associated with. But in the same way that software has been componentized and standardized, the same thing is happening in the data center. You're getting really commodity compute, commodity object-based storage, commodity network. You're scaling up as well as out, and then it turns out that and you're virtualizing, so you can play across all these networks, and you want to provision, and then you got to manage all this stuff. And I really think that this is going to be, in companies like Casat, and there'll be many, many companies active here. We are basically going from the era of the 1920s, when you made a phone call by having a man or a woman, usually a woman in those days, physically connect a wire.
Right.
Because if you talk to an IT manager, you ask them, how does your OpEx work? Oh, it's very simple. I take the number of servers I have, and for every 20 servers, I pay for a head.
Right.
And that's obviously not a scalable model. So there's this whole build out as this on-demand computing, or whatever you want to call it. Everybody's got their buzzword for it. As computing really becomes a utility,
right,
there's a fundamental rebuilding of how that works.
We enthusiastically agree with you. Dan, you're voting with your time, perhaps even more than your money, in terms of,
That's right.
of prioritization. So right now, how are you prioritizing?
I'm focused primarily on several wireless projects that have to do with provisioning, customer support, and things that enable a new category of applications, not necessarily the applications themselves. I'm also looking at another area in the near term of things that make the so-called Web 2.0 model more efficient. Because as, usually there's a rush to market on a lot of things like this, and efficiency is not something that's prized. Once it becomes established, the next wave is how to make the survival of the most efficient, not necessarily the survival of the cutest.
Yep.
And I think we're about to enter that phase on a lot of the consumer web applications that have been around for a while but haven't necessarily gotten traction. So those are the two primary near-term areas I'm looking at.
This is the moment for questions for anybody, for the panel. While people are coming up, I'll toss one further thing in. This gets back to, I think, Dan, what you said earlier about that you do believe that there's a low cost to build still accessible. At least there clearly is for what are emerge as products in Web 2.0 world. We had this experience last summer with an intern in our Menlo Park office. We thought he was working full time, the usual 16 to 18 hours a day, and on the side he produced Meebo. Which sort of made you stop and think about several items.
Though, the interesting thing about that, I think there's a little bit of a myth around that. I think to this point of capital efficiency, you can get to the point where you can get to a prototype, which is great for entrepreneurs because
Right.
they get good valuation for the companies. But the next step to scaling it, people don't realize how capital intensive
Well,
it
and
is.
Scott-
I'll disagree with you on that, Scott, because it depends upon your goal. And this is why I think there's been a real resurgence in angels versus VCs on this. VCs require a business that gets to a certain size scale to get a liquidity event
Right.
to get out.
Right.
Angels do not. We can take ordinary income as an angel. And so I think what we're going to see is the resurgence of a lot of small businesses that get to $5,
Yes.
$10, $20 million a year in revenue are 50%, 50%
I think-
profitability and
I think the
give dividend
key,
checks.
I think the key, and then I'm going to cut us all off so we can get at least one question in. The key is whether you have to build channel or you can leverage an existing channel. And if you're entirely on the net and you can get embedded into, which may be a matter of the attention economy rather than the capital economy, I think, Dan, you could be right. One of the things we've, of course, discovered that for every dollar that goes to build product, building a channel as a standalone company is usually 2 to 5 times as
yeah.
much, and that's where the big money gets
That's right.
spent.
Yes.
Sir,
Yes, when I saw that the title of the conference was When and Where Are Going to Be the Next Promising Startups, I come from Latin America and I get, I don't know, maybe 5 to 10 people trying to bring me new startups ideas, and I am not even a VC. And there are not enough people there doing that, and they are, you should see the thriftiness of each one of those startups that are enclosed. They cannot develop it themselves because there is no money. Do you see yourself coming to Latin America?
We're already in, by the way, I was born and raised in Latin America, so I wasn't born, I was raised in Latin, I was born in the US, raised in Latin America, and didn't come back here until I was in high school. So this is a personal issue for me. I'll give you the 5-second version, which is, I went back to visit my old junior high school 2 years ago and got tear gassed in a demonstration on the way to the airport, which is exactly what happened in 1970 as a 15-year-old when I was leaving Quito, Ecuador to come home. And I thought, oh my God, it's been 40 years and nothing's changed.
It's all your fault.
Yeah, maybe I'm the problem. But we are investing in Argentina. We just put up a software development center. We have investment professionals in Brazil and Mexico. I wish I could tell you that the environment in Latin America was better than it is. There are things to do there, but it is not like Israel or Eastern Europe or China or something. It's just a sad fact, but it's a fact.
But there are a number of angel groups starting up all around Latin America. I was asked to go speak to one in Costa Rica last month. And I do think that there's pockets of opportunity in various places in Latin America to do great things with less resources.
Sure.
Yeah, I don't disagree. I think that's right. There's technology can come from anywhere. I think that said, the capital markets, be they venture or public, are really here in the States. There's some proven models from Israel, from Europe, and that's not going to change in the near future. I think for 3I's perspective, we're not establishing a lot of offices in Latin America yet, but it's certainly on our radar.
Except they're extended to China and India.
Well, it clearly takes a generation to build an ecosystem that will support entrepreneurial activity with professional funding.
Heck, it's just getting going in Seattle.
Yeah.
Thank you very much. I think that wraps it up.